Everyone, and thank you for joining us today for a discussion on tax considerations for the entertainment industry during the ongoing pandemic and as we look ahead to a possible Biden administration. 2020 has been a dramatic year for most of us, and the ramifications of the COVID-19 pandemic are far-reaching. From production delays and event cancellations to increased focus on estate planning, and the impact of the upcoming election at both the state and federal levels, there is a whole universe of financial considerations and tax implications reaching into every corner of our industry. We have a terrific program aimed at addressing some of these topics, but before we get started, I would like to go over a few housekeeping items. First and foremost, this presentation is intended as general information on the issues presented and is not legal advice. Legal counsel should be sought separately for any specific questions or before taking any action in reliance on the information presented today. Second, please feel free to use the Q&A function to submit questions throughout the program, and we will do our best to get to all of them. Last, this program qualifies for California's CLE and CPE credit. For those seeking CPE credit, your first of 3 code words is entertaining. I will now introduce our speakers. Sam Olchek is a partner in our Washington, D.C. office and serves as chair of our firm's Tax and Retirement Policy Group. Sam advises businesses on federal tax issues involving representation before Congress, the Treasury Department, IRS, and state tax authorities. Shane Nix is a partner in our Los Angeles office who counsels companies and individuals in the entertainment industry on various transactional tax matters relating to the acquisition, disposition, and restructuring of businesses, corporations, and partnerships. Kathy Wonderly, who I could not live without, is a partner in our Los Angeles office who counsels high net worth families and individuals on a wide range of tax matters, including estate planning, probate, and trust administration, and premarital, postmarital, and transmutation agreements. Thanks again for joining us, and now I'll turn it over to Sam to kick us off with Biden's proposed tax plan.
Thank you, Michelle. Good afternoon, everyone. We're here to discuss Vice President Biden's tax plans in a Biden regime, and the reasons are twofold. First, his proposals, if enacted, will have a profound effect on tax and wealth planning for years to come. Second, he has a commanding lead in virtually all of the major polls. So I'm going to spend a couple minutes on the second point because that'll set the stage for what you're going to hear, particularly later on from Shane and Kathy. Okay, so as of this morning, 538's Nate Silver has a Biden victory at about 88%, an 88% likelihood that Vice President Biden wins the presidency. My first caveat, beware of polls. If you remember 2016, there were in the states of Michigan, Wisconsin, and Pennsylvania from August 1st to Election Day, there were 104 polls. Of those 104 polls, 101 had Secretary Clinton winning, 2 had them tied, and 1 had President Trump winning. Second caveat, in order for the Biden proposals to become law, the Democrats must take control of the Senate. That means that they need to gain a net pickup of 3 seats. And as it looks that Senator Doug Jones from Alabama will have a difficult time retaining his seat, that means that the Republicans will have to, the Democrats will have to pick up 4 seats. Again, looking at 538's Nate Silver, there is a 75% likelihood that the Democrats will win control of the Senate. But I will say that that is heavily influenced by the top of the ticket. Again, if you look at 2016, it was the first time in history in which the coattail effect was 100%. And what I mean by that was in a state in which Secretary Clinton carried that state. The senator, if there was a senatorial election, then the Democratic candidate won. And conversely, in a state in which President Trump carried and there was a Senate race, the GOP candidate won. The third caveat is there are 13 days left before the election, and 13 days is an eternity in this environment. And if you need any evidence of that, just look at the 7-day period between September 26th and October the 2nd. On Saturday, September 26th, the president nominated Amy Coney Barrett to the Supreme Court. The next day, the New York Times released its expose on President Trump's tax returns. That following Tuesday, 2 days later, you had the first presidential debate. You had the collapse of the COVID relief negotiations that Thursday. And then, of course, on that Friday, President Trump tested positive for COVID-19. So all that happened in a span of 7 days. So a lot can happen in the next 13 days. So with that, I'm going to turn to the key details of Vice President Biden's tax proposals. And we are going to start with his individual proposals. Bear in mind that that Biden's mantra is let's stop rewarding wealth and start rewarding work. And I think it's fair to say that his proposals are geared towards that. First thing, he has indicated, or he has said, he has stated forcefully that taxes will not go up for anyone, for any individual making less than $400,000. He has, his proposals call for restoring the 39.6% rate on itemized deductions. There is, I've heard a lot about restoring the SALT cap. I will tell you that the other benefits, i.e. capping the benefits of itemized deductions to 28% and restoring the so-called PEAS limitation for deductions for incomes above $400,000, those two items will negate a good percentage of the benefit from restoring the SALT cap. We're going to spend quite a bit of time this afternoon talking about the capital gain proposals. For individuals with incomes above $1 million, the long-term capital gain rate would be equalized with the ordinary income rate of 39.6%. This proposal, the next proposal, eliminate step-up in basis for inherited assets. This is why I tell Michelle and I think that they cannot go on vacation from November 1st. The end of the year. This is going to change law that has been in effect basically over 100 years. It goes back to, it predates 1918. There are additional state tax reforms. The Biden package calls for rolling back the estate tax exemption, but it is unclear. He has not specified what amount. And there will be other changes that a Biden regime would make, but they are likely to be more in the administrative realm. That's not all. The Biden proposal calls for creating a 12.4% payroll tax on wages above $400,000. So you're going to have this, what we refer to as the donut hole. You're going to have the 12.4% payroll tax would be would apply for the first 137.7, then it would not apply until a taxpayer has earned income above 400,000, and then that would apply. The 12.4 would apply above 400,000. It would be split between the employer and the employee. The other item on this slide that's worth noting is a proposal that would, a revenue neutral proposal that would convert the deductions for retirement benefits and into a flat credit. And that is designed to equalize the benefit irrespective of your tax rate. This slide I find very interesting because there are a number of ways to tax capital gains. And what this indicates is, and we'll talk about a mark-to-market plan, we'll talk about a wealth tax very briefly, but the Biden plan would, from a revenue standpoint, has the most impact of all of those plans. Okay, so let's spend a little bit more time talking about the capital gains proposals and the estate tax reforms. As I said, the capital gains rate would increase to 39.6% for taxpayers with incomes over $1 million. Elimination of step-up in basis. Here's an easy example. You have an asset. I'm sorry, I skipped an important point here. We don't have specifics, or I should say, the Biden plan doesn't include specifics on how to accomplish the elimination of step-up in basis. Is it going to be a carryover basis, or is death now going to be a realization event? We don't know for certain, but a 2015 Obama proposal would have treated death as a realization event. And since and that was during the tenure of a Biden vice president, so we will assume that is the case in this proposal. So you have an asset that has a original cost basis of $1 million, value goes up to $5 million. Present law, no capital gains tax. Under the Obama proposal, which we think is the Biden proposal, a $1.736 million in capital gains tax. That is assuming that death is a realization event. If it's a carryover basis, no tax, but the beneficiary inherits with a $1 million basis. If we overlay the effects of an estate tax, you see how dramatic the change is. Again, is there a double tax? Well, based on the 2015 Obama proposal, there's a $100,000 exemption. So the answer seems to be yes. So in this example, you have a $10 million asset that is now worth $15 million. The decedent owns this at the time of death. Under present law, there's no capital gains tax, but the excess over the $11.58 million exemption is subject to tax. You see the tax of about $1.37 million. Under the Biden plan, as we understand it, there would be a 43.4% capital gains tax on the $5 million gain, less an exemption amount, and the estate tax would be imposed on the entire amount. So the total tax is $6.7 million. So basically, if the Biden plan is as the Obama plan was in 2015, you see that there's a five-fold increase here in tax liability. In the interest of time, I won't. The reason I wanted to mention mark-to-market is because this has been a long time proposal that has by Senator Ron Wyden, and if the Democrats take control of the Senate, Senator Wyden would be the next chair of the Senate Finance Committee. A question I get all the time: when would these changes become effective? Could there be a retroactive application of the tax? And the short answer is yes. From a constitutional standpoint, it is not unconstitutional for the Congress to enact a retroactive tax increase. The lead case here is a 1994 case called United States versus Carlton, where the Supreme Court developed a two-pronged test saying that a 14-month, in this case, it was a 1986, this goes back to the Tax Reform Act of 86, a provision that provided a state with a 50% deduction. It was repealed in December of 1987. The court determined that there was a rational purpose for it, and the retroactive period, in this case of 14 months, was modest. I would also point out that there was a case in the Court of Appeals of the Federal Circuit called Nations Bank, Texas versus U.S., and that dealt with a specific increase in the estate tax rate from 50% to 55% in the Clinton administration. It was enacted as part of OBRA, the Deficit Reduction Pact, in August of '93. It was made retroactive to 1/1/93. Nations Bank was an executor, challenged the retroactivity, and the court concluded, based on Carlton, that it was constitutional. So, in the 2 minutes I have left, let's talk about the Biden tax proposals. A key element of the tax proposals, if you operate in corporate solution, is increasing the corporate tax rate to 28%. The other that is a bit less understood, but could have quite an impact, is a 15% rate on companies with book incomes in excess of $100 million. And this would work essentially as an AMT. So it'd be a corporation, if it is subject to this, would pay the greater of this, the tax under this proposal, or the 28% corporate rate. The last item on this slide that I want to highlight is for those of you who are in the real estate industry. The Biden package wants to reform the loopholes in the real estate industry, and Section 1031 will be on the chopping block for two reasons. Primarily, first, the thought that in 2017, the real estate industry avoided much of the revenue pain. And second, given that the president is so heavily invested in real estate, there's an element there of interest in addressing that industry. There are additional business tax proposals. They are primarily geared towards incentivizing businesses to make certain investments, carbon-free manufacturing, climate change, a manufacturing communities tax credit, and other such proposals. For sake of completeness, we have included here these two slides on the GOP proposal, and all I'll say is that if President Trump is reelected, I hope you join us for a post-election presentation, and you will have the benefit of having these two slides that we would cover in that event. So with that, let me turn it over to Shane and can discuss how all this could impact the entertainment industry. Shane?
Thanks, Sam. So the two topics that I'm going to cover is how the pandemic has impacted the music industry as well as the film industry, and various tax issues that have come up as a result of that impact. And where applicable, I'll reference how the new tax law could change some of these considerations going forward if Biden's elected and the Senate flips and there's a tax law change. So first, I want to go over the music industry and the impact that COVID has had on it, and with a primary focus on, given the impact, how are music artists monetizing their assets. So as a preview, the global music industry is worth over $50 billion, and it's made up of two major income streams, the first of which is live music revenue, and the second of which is from recorded music. The chart that I've set forth on slide 21 shows that the music industry revenue has gradually been increasing over the years, and it was projected to continue to increase into 2023, subject to now the impact that COVID's had. 50% of music revenues are from live recordings, and as we've heard in the news and probably have seen in our personal lives, is that the whole touring industry has been shut down as a result of the pandemic. And many artists have resorted to other means, such as streaming live music events. But I don't believe that has made up for the lost revenue, which is effectively represents 50% of the revenue of the music industry. So substantial hit to the music industry with touring. Likewise, the recorded music income streams, although not as devastating as touring, there has been a decrease in revenue with recorded music. Specifically with streaming, we started the year with streaming revenues up 20% over 2019 in the same period. And then after COVID hit through July, that 20% increase went down to 13%. So it's still positive increase over 19, but a substantial decline. And streaming revenues since over the last 6 years has moved from 9% of total industry revenues to 47%. So streaming has become a more and more important source of revenue. Physical music sales are down, and a lot of this is obviously because people have been quarantined, have not been going out and buying music, and likewise the streaming has been an impact because people are not going out to gyms and other places where they would consume streaming music. So how does that impact entertainers? Well, obviously music artists have lost sources of revenue streams. So one avenue that can be explored to generate revenue or cash flow would be to enter into secured lending transactions where the music artist would borrow money from a third party and secure the loan with their music assets. The benefit of that is that they obviously get the loan proceeds tax-free, and they continue to control their music catalog to the extent that they own the copyrights. The downside is that the loan generally is going to be repaid with royalty streams, which would be ordinary income. So if you borrowed $1 million, you have to earn $2 million after tax in order to repay the debt. We've seen an uptick in catalog sales through the pandemic and coming in from last year. The catalog sales prices we've seen at multiples from 20 to 30 times revenue, and so that's a substantial potential way to monetize the catalog and music assets. And the benefit to a catalog sale is that you get cash potentially at capital gains rates, but the downside is you give up ownership of the underlying copyrights, so that you don't ultimately get to control how that music is exploited going forward. And just to kind of give an overview of some of the issues that come up in catalog sales, in the music industry, all payment streams to the music artist generally is called a royalty. But what's important when analyzing music catalog sale transactions is just because something is called a royalty doesn't necessarily mean for tax purposes that you're getting capital gains. And specifically, you have to look at the underlying character of the income stream. If the artist owns the copyright, then they own the copyright, and their payments are royalties. If they don't own the copyright, then generally the receipt of the income, even though it's called a royalty in the contract, would be compensation for services. And to determine whether or not the artist owns the copyright, you have to identify, for income tax purposes, it may not necessarily be that, if they have the title in their name, that they're the pure owner. For income tax purposes, you look to who has the benefits and burdens of ownership, which for the most part is looked at as who has control over the exploitation rights in terms of making exploitation decisions. And if the artist owns those exploitation rights, even though there may have been a collateral assignment to a recording label, potentially the artist may still be viewed from an income tax perspective as owning the underlying copyright. And there's also a distinction to be aware of between sale versus the license of a copyright. From an income tax perspective, even though the documentation might refer to the transaction as a license, if a copyright is licensed in perpetuity to a third party or for the life of the copyright, then that for income tax purposes is treated as a sale, not a license. Anything that is an assignment for less than the term of the copyright is treated as a license for income tax purposes. If it's treated as a license, then the artist or the licensor still owns the copyright from an income tax perspective and could then sell the copyright. If it was previously sold there may be circumstances where you can still get capital gain, but in other circumstances you may not be able to. So once you determine copyright ownership, the general rule is that self-created music copyrights are ordinary assets. So the default would be that when you sell it, you get ordinary income. But under Section 1221B3, the taxpayer can make an election to treat the self-created copyright, the gain from the self-created copyright, as capital gain. And so that's an important provision in this context. And just to know, under the TCJA, the House bill, I believe, was set to repeal this election, but the Senate bill ultimately did not repeal. So this election still remains current law. And I don't believe that there's any indication under the Biden proposal whether or not that would be taken away. But if capital gains, it goes away for people earning over $1 million, then obviously this benefit or this election becomes a moot point. So as I said, when dealing with these transactions where we're trying to monetize with a catalog sale, if the artist does not own the copyright, then the income stream likely is service income and would be ordinary income upon a sale. Largely because the underlying case law states that if the copyright if it's just a financial interest in an income stream to a copyright alone, that does not constitute ownership of the copyright. That's just a contractual right to receive income. So if you sell that contractual right, that's ordinary income. And if it's treated as non-qualified deferred compensation, you also have to consider 409A in terms of the analysis. And there's a number of different revenue streams that artists may have, including recording revenue and recording royalties. In order to get capital gain on a sale, you have to actually own the underlying master recordings and sell those recordings in order to get capital gain. The writer's share, the artist may own whether or not they own the copyright. If they own the copyright, then our view is that if they sell the copyright along with the writer's share, then that can be cap gains eligible. And then publishing rights, in any of these scenarios, you have to own the underlying copyright or the master recordings as applicable in order to potentially be cap gains eligible. And we've dealt with a lot of different scenarios where on the face of the situation, it may not seem like the artist is the copyright owner. So it's important to do the analysis in order to confirm whether or not they are truly the copyright owner. And an example of that is we represented a client who in the 1980s licensed the copyright in perpetuity to the record label, which as I mentioned before, that's treated as a sale for income tax purposes. But in connection with that sale, they continue to maintain a 5% interest in the underlying income streams. And so in this year, we were going to sell all of their music assets, or assisting them with the sale. And what we determined is in that context, because that's an income stream that relates back to the original sale, that we got comfortable that we could make the election under 1221B3. And there's also other circumstances that can arise, which I'm not going to go through in detail in the interest of time. But if you have questions, feel free to reach out to me after the presentation or in the next couple of weeks. So as the upside to a catalog sale, as I think I previously mentioned, is that you're potentially cap gains eligible. But if it's a full catalog sale, then you've lost the right to have control over the exploitation of the music assets. We have a client which we've gotten permission to mention them. It's a company called Empowerment IP Capital Limited. And we've been working with them this year and put together a structure, which I can't go into the specific details of the structure, but the overall benefit of the structure is that the music artist is able to achieve capital gain treatment on their catalog and get current cash, but they also retain the right to regain control over their asset in the future at a price less than fair market value. So if you have a client that if a client's looking to maximize their proceeds, then they probably should be looking at a catalog sale potentially. If they're looking to get cash, but they still want to regain control or have certain future rights over the underlying asset, then this would be a structure for them to consider. I also want to talk about briefly an IP topic, which is copyright termination rights. And the reason I think this falls under the category of monetizing music is that for any copyrights that were created by an individual after 1977, the individual has what's called a copyright termination right. And that allows the individual after 35 years to reclaim ownership of the copyright that they previously disposed of, either in the form of a license or a sale. And if it's a license, it obviously comes back to them. It's just a termination of the license, but they're allowed to terminate it early and renegotiate the fee. If it was previously sold, the termination right allows them to reclaim the asset. And the important point is for no consideration, and then they can renegotiate the sale price. So this is another IP concept that potentially, if you meet the requirements, can be utilized to monetize previously disposed of copyrights or music catalogs. Now, under the statute, it's generally a non-waivable right by contract or otherwise, and that's important because if it's truly a non-waivable right, that means that even if the contract says that it's being waived or sold, by statute it may not be able to be waived. Now, we have been informed from various music lawyers that they think that there may be a way around that. So that's something from a non-tax perspective to be aware of and take into account. The creator's statutory heirs may have a similar right as long as the asset was not bequeathed under the creator's will. And the copyright termination right does not apply for content that was created on a work-for-hire basis. And work-for-hire basically means it was prepared within the scope of an employment relationship, or it was a specific type of work created, and then the parties agree in writing that the underlying asset is a work made for hire. And music is not one of the enumerated works, although I think there are arguments that some people may make that a record is considered a compilation. But I think the general view is that music is not under the second category. And so therefore you have to look to see whether or not the asset was created under an employment relationship, in which case it's a work for hire and the individual does not have the termination right. So an important question that then arises from that analysis is whether, when the artist exercises the termination right, how is that treated for income tax purposes? And because we've only recently crossed the 35 years from 1978, this right has only recently come into play. And so accordingly, there isn't very much guidance. There really isn't any guidance under the tax authorities to determine how this is taxed. But we've analyzed this in various contexts. And as a general rule, we believe that when you exercise the termination right, that you should get the asset back tax-free. And that's potentially under two different theories. Either it's a non-compensatory option, or alternatively, it's you've always owned the interest in the copyright, and it's effectively a reversionary property interest. So that's just another way to monetize copyrights. The next topic I just wanted to mention, which I'm not going to go into very much detail on, is Nevada Incomplete Gift Non-Grantor Trust. This is a trust vehicle who one of our partners here, Kevin Gasomian, specializes in these types of trusts. And this trust has a number of non-tax benefits, including the assets that are put into the trust are protected from the creditors of the individual. Another ancillary benefit is that if the trust has non-California source income, then that income is not subject to California tax. It's because for federal purposes, the trust is treated as a separate taxpayer, and many states also respect that same treatment. So this is a potential vehicle that has a lot of different benefits, including if, for example, a business entity is sold that holds music copyrights or a music catalog. The portion that's held by the trust can potentially be not subject to California tax, given that it's owned by a non-California person. But these trusts are very sensitive vehicles, so you need to make sure that you understand all the ins and outs of these trusts and make sure that they're properly done. because they're subject to challenge from, just general income tax principles and different doctrines. So we need to make sure that these are properly implemented if you're considering doing these trusts. Now I only have a few more minutes, but I wanted to move on to the film and TV production timing differences. If you've joined us on other presentations in the past, we've gone over this topic in more detail, and this largely arises from circumstances in which a film production has income in one year but isn't able to take a deduction until a subsequent year. And after the TCJA, with the repeal of NOL carrybacks, which have now temporarily been resurrected under the CARES Act this year, that really puts some production companies in a bad position because they have income in year one that they've used for production expense, and then they can't take a deduction until a subsequent year. And that deduction, if it turns into an NOL, is further limited in use by a number of loss limitation rules that came about under that TCJA. So this slide, I basically just put forth just how impactful the global box office revenues have been historically, and they've continued to grow. But as everybody knows, the movie theaters have shut down, and productions have been delayed, and so there's a shutdown going on right now, and that can potentially impact timing differences. So I think the principal thing to be aware of is when you represent a production company, the first question to ask is, does the production company own the copyright or do they not own the copyright? If they do not own the copyright, then it generally is going to be looked at as a work for hire production. And what that means is that the production company, if they get an overhead account from the studio, that income generally is going to be includable in income, but they don't own the copyright. So any use of those funds for production costs would be currently deductible. So the key in these situations, especially with production delays, is really to time the receipt of the money from the studio only to the extent that you're going to use it in that year. Because if you receive $10 million in year one and then the production's delayed, you may not have a current expense until year two and be stuck in the same situation. So it's important to time those payments. Alternatively, there's certain ways that you could potentially exclude overhead payments from gross income, and that's based on an older revenue ruling from the 1950s, which effectively says if you receive a payment that's earmarked for certain things like equipment and the like, and those assets are titled, in this example, in the studio's name, and you have to return any funds that are not used for those earmarked purposes, then you're only receiving those overhead funds as an agent for the studio, and they're excluded from gross income. So that's another potential way to navigate the issue. Likewise, if this production company is an accrual method taxpayer, you may be able to defer advance payment for services until the next year if you make a certain tax election. And so the last slide that I want to cover before I turn it over to Kathy.
Shane, can I just interrupt you for 1 second? There was an audience question.
Oh, sure.
The audience question asked, is the NING basically a Nevada Asset Protection Trust or something a bit different? And I think we just need to point out that it is a bit different because of the shifting of the income with the NING, that it's subject to Nevada tax, which is zero in income tax and not California tax.
Right. So, yeah, if it's not California sourced income, then the NING is treated as a Nevada taxpayer. And because there's no state income tax in Nevada, any non-California source income would not be subject to state income tax, including gain from the sale of an asset that's not California source.
Thanks, Shane. That was just an audience question.
Sure, no problem. So just wrapping up this point, if you own the copyright, the production company owns the copyright, this is where a timing issue can come up, because if you own the copyright, the production company is required to capitalize production costs, and as a general rule, you can't start depreciating the asset until it's placed in service. So if you received money in year one that was taxable income and you have to capitalize those costs, but you don't place it in service till a year after year one, then your income and your deduction don't line up. And so that can be an issue. When 181 was and currently is around through the end of this year, that basically, if it was a qualified U.S. production, 181 election allows a company that owns the copyright to effectively be in the same position as though they were a production service entity, because if a 181 election is made, then the production company can deduct production costs as and when incurred. But again, 181 is only effective through 2020, and if the past is an indication of the future, we might not know for a while if 181 would be further extended. But under the TCJA, the bonus depreciation rules were extended for qualified U.S. productions. So there's a possibility that if it's a qualified U.S. production, you can still take, an immediate deduction. But the key difference from 181 is that for bonus depreciation, you have to place it in service. So you wouldn't get your bonus depreciation until you place it in service. And when you've got production delays during COVID, the example would be, you're planning to place it in service in year 2. So maybe you elect to defer certain payments to the next year if you're eligible and you're planning to place it in service, but then a production delay pushes it into year 3, and now you're stuck with a timing difference. So it's important to keep these points in mind in advance of structuring the transaction so that they can properly be planned for, whether it's trying to bring parties in as a capital member in a partnership so that the money's received tax-free and you can navigate this timing issue, or make certain tax elections to defer certain types of income. So those are the issues that we've been navigating during this pandemic environment. I want to take a minute before I pass it to Kathy Wonderly to mention the word for the CPE credit. The word is uncertainty. Again, the word is uncertainty. And thank you, everybody, for listening. And I'm going to pass it on to Kathy Wonderly.
Thanks, Shane and Sam. That was very helpful and interesting. I enjoyed it and was also a little bit, concerned about some of these proposals. As an estate planner, we absolutely love the step up in basis, especially being from California. Our East Coast planners are all very jealous of us because in California, because we have community property, if you hold an asset as community property, you get a full step up on basis in the entire property on the death of the first spouse. So it's something that estate planners really have used to the advantage of our client, and definitely we will be thinking of new ways to benefit our clients if we lose that option. So let me start here, and like a lot of tax law, it's really all about the numbers. And when clients call me, sometimes their first questions are, well, what's this 15,000? What's this 11.58? And so the 11.58 million is what you can give during your life or on death without incurring any estate or gift tax. The generation skipping tax is a similar number, and they're usually tied together and allows you to make those gifts go on for generations without having a tax at the second level. Annual exclusion, that's the $15,000 number that you all have heard about probably. You can give that to any one person each year. And so you can use that in your planning to slowly build up trust. I have clients that are in generation 4, and there's 30 grandkids and great grandkids, and they are able to use that successfully as part of their planning. We also have the extremely low interest rate environment, and this is almost unprecedented. It impacts so many different parts of our planning and really probably all your lives. And skip to this slide here while I talk about that. As you can see, these numbers are very low, and why this matters, we'll get to a little bit later in the presentation, but basically it allows our estate planning to be more effective for the clients. It allows us to have lower hurdle rates on growth of assets, to have good results for the clients in passing wealth to the next generation. So these numbers here impact kind of how effective our planning can be. I don't want to miss this piece right here. This shows the fluctuation that we've had in a very short period of time with respect to our gift and estate tax exemption amounts. And the tax rate itself has, remained constant over this time at a pretty high number of 40%, and, could go up to be an even higher number. in the future, 45, even 50% potentially. So we're talking about significant dollar amounts if we keep amounts in excess of your exemption amount in your estate. And that's just, the fact of the matter. But luckily, there are lots of tools and ways we can get assets out of your estate. Okay, so we're going to talk a little bit about some of those. I like these graphics. I mean, one of the common questions that I get asked is, I don't really, want to give money away to my clients yet, or to my children yet, or my, the charity yet. And so we usually structure these transactions so that you have, some ability on who's controlling the assets, who's distributing them. Maybe there aren't even distributions going out, or at least not significant distributions while you're living. So there's a lot of ways you can structure this so that even though your bucket is empty right there, and we've transferred the money for estate and gift tax purposes, you won't feel like it's so empty. We have some flexibility that we build into our planning. So let's talk a little bit about these transactions. And some of these are extremely useful in the low interest rate environment. I mean, I think that helps all of these transactions, is having that low interest rate environment. We'll start with a GRAT. And a lot of clients have been asking me about GRATs. I think that they're reading about them in financial magazines. What's right underneath that, the charitable lead trust, there's another term for that people often use, is CLAT. So GRAT and CLAT. I'm getting a lot of questions about these. They're similar in how they work. And I'll have a little example here. A grantor retained annuity trust means you are going to contribute some money to the trust. So if you make a $10 million contribution, it's going to grow over time, right? And each year you're going to retain an annuity payment that comes back to you. So you get money back. And you see in my example, you put in $10 million, you're going to get $10.3 million back over the course of this 10-year term. But because we have, and this goes back to those low interest rates, we only are using a 0.4% hurdle rate, basically. So you don't have to have great investment performance to beat that. So in this scenario, I used a 6% growth option, and you end up passing $5.4 million onto your beneficiaries, whoever they might be, family members, friends. And this is basically without using any gift tax exemption, or less than $1 worth. A lot of clients love this. There are some positives and negatives, of course. I think it's a positive, but during the course of the GRAT, you actually have to, as the grantor, pay all the income tax on the growth of the GRAT. So that's great from my perspective. It gets more money out of your estate, and it allows the growth within the GRAT to, be even higher. Some of the negatives, GRATs, for the most, GRATs as they are, unless you do some additional complex planning, do not allow you to get, they're not GST exempt when they terminate. So that $5.4 million, it can go to your kids. It's a little harder if you wanted it to go to your grandkids. We have some options for it, but generally speaking, you don't allocate the GST exemption until the end, and so we usually don't like to do that. It usually is not the most effective use of that. The other big risk, and this is why we have varied terms for our GRATs, is that if you die during the term of the GRAT, then this planning kind of doesn't work, and it's undone, and it's includable in your estate. So you can choose the term of the GRAT. Often, I'd say most of the time I'm using shorter terms than 10 years. I'm using 2 years a lot right now, sometimes 3, 5. We run the numbers and decide what's best based on the financial advisor's advice and the client's needs and age. But GRATs are very efficient tools to pass generation. To pass wealth to the next generation. A charitable lead annuity trust works very similarly to the GRAT, except for instead of you getting the money in the beginning, paid back to you, it's going to a charity. And if you structure this charitable lead annuity trust as a grantor trust, then you get an upfront income tax deduction for that. Again, I generally recommend this type of planning for clients who have charitable intent, who want to give money to charity already. And let's talk about the way we can do that the most efficiently, the most benefit for them on the income tax side and on the estate planning side. All right, so some of you might have heard of this concept of a sale to an IDGIT, a sale to a gift trust, a sale to an intentionally defective grantor trust. Those are that's some of the terminology that goes along with this concept. And I've created a diagram that it is relatively simple. It's not a simple transaction, so it takes a few diagrams to get to it. But basically what husband and wife are going to do are sell their assets to separate IDGITs or gift trusts that are for the benefit of their kids. We can even build it in that one of the spouses might be an initial beneficiary of these gift trusts. So maybe in husband's gift trust, wife is a beneficiary during her life. That option is sometimes appreciated by clients who aren't quite ready to completely get rid of their assets. We also, the way we do this, as you can see on the slides, we make a seed gift to the trust. And there are lots of ways to do this, so this is just an example. Every single client situation is so unique and different, and we model it out for them, what's going to work the best for that client. You make a seed gift to the trust, then you sell the assets to the trust in exchange for that money back and a promissory note. So now you have your money back that you gifted to the trust and a promissory note, and you're receiving payments from the trust of interest going forward. The trust has the asset, so you're freezing the appreciation. In your estate, you're only getting back what you sold it for. You're also going to sell it for a discount probably. So there's a huge benefit to what you are able to put into the gift trust without using much exemption. The way we usually structure our promissory notes is that you can prepay principal. So maybe it's interest only, but principal is paid back to you going as you need or want going forward. And the end result is the money is in the other bucket and your estate has less assets. A little bit more of an overview, kind of some of the consequences of this transaction. I mean, one thing to note is that seed gift I talked about is a taxable gift. And so if you have exemption, the way that we make that work is when you have exemption left. That's why a lot of our clients are doing this right now. They're using that 11.58 million exemption to make these seed gifts, or at least a portion of it. And there you go. You just got the appreciation out of the grantor's estate. Okay. So now I'm going to switch it back, I think, to Michelle to see what questions we have from the audience. And there was one last thing I wanted to say that I had talked to Michelle about in advance, is that because of the uncertainty surrounding this election, we are really encouraging our clients to reach out to us in advance of the election so that we can get started on their planning. Because in the event that there is a change in the administration, we expect the year end to tick up to a level where we're going to be really limited in maybe our timing to get transactions done. So we want to get it started as soon as possible.
I want to thank everybody for joining us today. Now that we have you thoroughly depressed, feel free to call on any of us for help or doing some tax planning before the end of the year. For those seeking CPE credit, your last tax code word is tax. This will now conclude our presentation. Thank you for joining us.